So there's this expression in, like one of these quips in the stock market says, buy the rumor, sell the fact. So you buy a company coming into earnings season, when they report earnings, you sell the stock. And it's a very upside down market at the moment. So what we're saying is what people are doing is selling the rumor and buying the fact. So that's what we wrote last time, was sell the rumor, buy the fact, because the economy was slowing down and we were seeing stocks going down, but the earnings estimates hadn't been cut. So strategists were waiting to see what the earnings were before cutting the earnings estimate. So even though we saw stocks falling quite dramatically in the prior several months, we saw that during earnings season, a lot of companies reported, we expected a lot of companies to report very bad earnings below expectations, but for them to go up. So that's selling the rumor, buying the fact. And so last one, we said sell the rumor, buy the fact. Now we're selling and buying. So the market has had a good month with good earnings, and the prime examples of that are some of the biggest companies. So Amazon, Procter and Gamble are good examples of companies that lost money or made a lot less money than expected, but the stock price went up. I thought I put this in 10-point print so nobody could read it, because nobody ever does. Should I read that out loud for everyone? General advice. Now, compliance is a very important part of our industry, and so Fortrend Australia has an Australian financial services license, and we introduced your accounts to Fortrend Securities Inc. And Fortrend Securities Inc. really acts as a conduit, compliance conduit, before we introduce them to the clearing firm. And so we here are regulated not only by ASIC, but by the U.S. regulator FINRA, and sometimes they have conflicting stuff. So one of the challenges that we have at the moment is that all this research that we write is all compliant with Australian law, and it's done in Australia for Australian clients before your account is introduced to the U.S. firm. But FINRA is saying that because we introduce the account to a U.S. firm, that you're also clients of the U.S. firm, and because I'm registered with the U.S. firm, therefore all the research should be regulated in the U.S. as well. And I'm saying, no, guys. And they're saying, I'm not going to go, I got to be compliant in Australia, and there are conflicts. I can't be compliant in both places on writing research. Anyway, market up 8%, earnings estimates down 1.5. So we do have earnings estimates coming down for some sectors, but actually going up very, very strongly for the oil sector. So the oil earnings estimates are going up, and some of those stocks are at very low PEs now. Apache, for example, at 3.3 times forecasted earnings, because they're not expected to stay up there. But we did see earnings estimates overall fall by only 1.5%. And with an 8% increase in the price earnings ratio has increased from 15.3 to 16.8. Now, 15.3 with a 10-year treasury at 2.65 implies that you're getting a payback on your investment. So if you put in $100, you're going to get your money back in 16.8 years without considering the growth in the earnings. But if those earnings are growing, you're actually getting, you put in, $1 million, you're going to get back $1 million in about 14 years. Whereas this is more like a 60-year payback, right? So to get your money back on a bond. So bonds are very low yields, and they're likely to stay there, right? So just to put this into perspective, when I first started looking at the stock market, we had Alan Greenspan come in and Ronald Reagan coming in. And after President Carter, we had, and Nixon, we had some price controls, and we had very high inflation. And the 10-year treasury was at, is that for me? You want me to help? I see, you're the only ones with ties here today. See, how do you like my new tie? I traded ties. I think we both got a good deal there. We traded ties there. So when we had the oil embargo from OPEC decided to control the flow of oil, there were price controls under Nixon, and there was very high inflation, 10% inflation, and the 10-year treasury was up at 10% on the 10-year treasury. So price earnings ratios were the inversion of 10%. We had P's at 10. So if the price earnings ratio is 10 and the 10-year treasury is 10, and what happened during my lifetime in the market is that the interest rates went from 10 to below 5. And when it goes to 5, you'd expect the P to go up from 10 times earnings to 20 times earnings. But once you get below 5, because they're both a 20-year payback, right? And the the trade-off there is it's a 20-year payback with growth in earnings and no risk in bonds. So you get the risk trade-off. So you get some growth in those earnings, but you don't pay more than 20 times. So what happened is that, of course, the 10-year treasury continued to fall, and the price earnings ratios don't go above 20. So right now, what we would say is that PEs with the 10-year treasury below 5, we should have a PEs of about 20. But we don't, because right now we've got an expectation that there's some risk in those earnings. And there's substantial risk at the moment because there's so much more debt in the US. But I'd say the market looks pretty cheap. I mean, people are pretty concerned right now, and there's good reasons to be concerned. And China's one of them. I mean, and is Pelosi going to get shot down? Is her plane going to get shot down? Is anyone following that?
By who?
Yeah, by who? By Trump? Trump isn't that? No, but
That's just Trump.
so I've got a very strong opinion on that. But my strong opinion is that the U.S. really needs to change their position and say we support an independent China, an independent Taiwan, and I think that the U.S. needs to flip on that, because they act but they don't say. They act and act and act as though they're going to support Taiwan, but they won't come out and actually say it. Right? Only the Vatican says it. How many countries support Taiwan as an independent country? Three countries in South America, 6 or 8 countries in the United Nations treat Taiwan as their own separate country.
About 10 or 15, I think.
But 10 or 15.
Yeah. What percentage of global capacity, chip capacity?
What, 50%? So there's 3 companies, right? I mean, it's a strategic asset. They own Taiwan Semiconductor, and Taiwan Semiconductor is very dependent on China already. So, you know, all these ties. I mean, anyway, Pelosi's going. I think it's great that she's going to Taiwan. I think that, but that it's such a big deal is kind of confusing. Lawrence Summers works at Harvard now, but he was the Treasury Secretary, and he's on Wall Street Week every week. So he's the guest speaker on Wall Street Week, and he's highly critical of Jay Powell's comments on neutral. There's more comments out by the Fed today saying we've got to get inflation under control. It's much more important than economic growth. So we've got to control inflation. I see it as a pig in the python. So has anyone not heard the, I mean, who knows pig in the python story? You know? Lori, you know pig in the python story? Sorry.
Sorry.
Lori. I got, you know, my accent isn't that good. So, you know, I'm having this conversation with people about patents all the time, and they're saying patents and patents, and, you know, so bear with me. So the Fed is saying they're going to raise rates. I think it's wrong. My view is that the 1 trillion, let me come to it later. Okay, so why do I think it's wrong? Bottom up, stocks have been solid in anticipation of a bad earnings season. So they're moving up in a bad earnings season. So we're buying the fact. We're selling Goldman Sachs and buying Citigroup. And we'll go into more detail. Do you want to give a 2-sentence on that? No? Okay.
It's only a couple of spots.
Okay. Okay, so big movers in the market. I'm really weak in the mining stocks, which is very strange. And so is Bitcoin. So, you know, you'd think that in an inflationary environment, the gold stocks would be the inflation hedge. So Bitcoin would be the inflation hedge. And we're seeing the exact opposite happening in today's world, where Bitcoin's gone from $60,000 to $20,000, and gold has gone from what, 21 to 1,700 an ounce. But the gold mining stocks are being crushed here, and a lot of politics going on in China, and concern about the government, like ad hoc regulation. But on the upside here, U.S. Steel, Nucor, Etsy, you know, they're like up and down a lot, so they're very volatile. But big recovery in the semiconductor stocks. So Advanced Micro, ASML, NVIDIA, and Applied Materials and Micron Tech. So last month we had Micron announce that their earnings were going to be below expectations. So Micron makes the memory chips and the flash memory chips. And that's a very important, but more of a commodity end of the market where they compete with Samsung. And what we've seen is that NVIDIA is taking over from Intel, which is the one company that really had a bad result. But when Micron came out and warned last month, all the chip stocks were down about 20%. Then as the earnings came out, they all went up about 20%. So we've seen a lot of volatility in the chip stocks, except for Intel, which went down and stayed down. Okay, but ASML is a very interesting company that I'd like you to understand a little bit about. The way you make a semiconductor is you take sand and you put it into a cylinder. Then you slice the cylinder into discs, 12-inch discs. And then what you do is you coat them with something that is doesn't transfer electrons, a non-conductive material. Then you burn with a mask, you burn groove patterns into the chip, and then you chop them up and stack them on top of each other and put a wire in each end. But when you do this, has to be in a clean room, and there are a lot of very fancy equipment. But projecting that image onto the disk is monopolized, is a very, very, very fancy machine. But ASML completely has a monopoly on that end of the market. And so they do very well in anything. Anyone wants to build a semiconductor manufacturing plant, they're going to have, like, in Applied Materials built a plant. So think of Applied Materials as being like roll-up. So they're going to do the major contracting, but they're going to need the ASML or Ultratech Stepper or hundreds of other companies that do tools that go into the plant. And so NVIDIA doesn't own any plants, right? Intel owns plants, but a lot of the semiconductor companies, they just design the chips and then have them manufactured by Intel, Samsung, or Taiwan Semiconductor, which is the prime asset that China wants to control, that the rest of the world doesn't want them to control, which is why Pelosi's going to Taiwan, right? But big recovery in the stocks today. And can we hear? I wonder if anyone can hear me on the other side. Oil up, except for Baker Hughes here. Baker Hughes and Schlumberger, the oil field service companies, are down. But big across the market, semiconductors, big recovery in semiconductors. Everything's up except for pharma, and it's a big result. But the FANG stocks had some big reductions in earnings estimates. But you can see here that the FANG stocks are actually computers, semiconductor, software. FANGs, there we go. So FANG stocks are up, and the earnings estimates are down. So who's driving the FANG's earnings estimates down? I should know that. I think it's ST and it's ST. So even though ST's earnings are down, but the price is up. So does anyone here know what ST does? You're not in that market. Okay, so there's two companies that are very popular at the moment with the younger generation, Etsy and Shopify. And Shopify allows you to build a website and to have payment systems on it. So it's like a shopping mall where they allow you to create a shop within a shopping mall using their website application. So if I wanted to sell chairs, I would set up a website on Shopify. Okay? Etsy allows you to sell product next to someone else with similar product. So if you're selling a chair, you'd have all these different companies that sell chairs on a menu of companies to buy. So if you're selling the chairs, you want to not take vacation, you want to keep selling and get good return and get to the top of the list. So Etsy is more for arts and crafts, because somebody who's making some shirt that says Joe on it, assuming they could sell something like that, they would sell it on Etsy, right? Maybe they make a shirt that says Mike on it, right? So but you would get lined up next to different people doing the same thing. And so Etsy is a marketplace that's different than Amazon or different than eBay, but it is the go-to place because you create your own stored image on the site, and it's much more of your own store compared to eBay. So that's what Etsy does. But this is the relative value model. Of course, it shows the price divided by sales and the earnings divided by sales. And the price earnings ratio for oil is very low because the margin now is very high. So what the market's saying here is for oil, they expect the earnings, the margin, the return on sales at 20% or so to come back to 15%. So those earnings estimates could fall by 25% and the stock prices wouldn't go down. So what we're seeing here is, and that's dragged down further by Apache, and it goes up for other companies. but it's really saying it'll come back into the pack here. And you could see those earnings estimates, or the return on sales drop from 20% even to 10% before the stock prices took any pressure. So you can see big cuts in earnings estimates before oil goes down. And the FANGs here have high price earnings with slope. So price to sales, the slope for FANGs is steeper than the slope for the average. And so the FANGs have a high price earnings ratio because they've got growth in those earnings. So this allows us to see where we want to invest. We want to invest in some of these low growth, low PE stocks with high yields and high cash flows, or do we want some software and some semiconductors and some healthcare? I would say bio and pharma probably should have higher PEs. Is this slope right? So the slope should go through here. So it's off by just a little bit, but I should have adjusted my line there. But financial institutions are always in this sort of range, and there should be more financials in the market. So unemployed. So on our top down, and any questions on the relative value model, like housing and aerospace is pretty low. That's because Boeing's got its problems. So that drags it down to the left. Questions? Okay. Unemployment 3.6%. Wages are up 5.2%. So the inflationary pressure is coming from wages. So the 5.2% year-over-year growth in inflation in wages is inflationary. The CPI is up 9.1% and 5.2% excluding food and energy, which is more volatile. And so people take out the food and energy to see what the core inflation rate is. But 9.1% increase in prices makes, the wages are not keeping up with prices. So if wages are not keeping up with prices, people are going to have to cut somewhere, and where they're having to cut now is they're going to drive less, and they're going to probably continue to buy food. And that's what we're seeing in the earnings results now, is that people are still buying food and Kraft is doing okay. So the producer price indexes are up 11%, and that has to do with supply chain issues, but it's up 8.2 excluding food and energy, but higher in the producer end of the economy than it is in the consumer end of the economy. And that's because capacity utilization rates have actually increased to about 80%. So when you're below 80, you're going to have less inflationary pressure. And when you're above 80, you're going to have more inflation. So 80 is considered to be the relatively neutral rate, but it's come up from 78% to 80%, implying that there should be some price pressures. And there are pressures in different sectors like paper. Imports are high, the trade deficit 98 billion. So that's a really bad number. So if the US exports more than they import, then they're going to export US dollars, okay, because the foreigners are going to receive US dollars for what they sell net to the US. So the foreigner is going to receive US dollars. And so when China and OPEC receives US dollars, they have to do something with those US dollars. And the only thing they're really allowed to do with it is buy, well, let's say on Saudi Arabia, the only thing they're really allowed to buy are exchange traded funds and bonds. They can't go out and buy a port, right? You can't have Saudi Arabia buying a port, because the American public would say they can't, China oil can't buy ConocoPhillips. They can't own that asset. They can't come and buy, again, like in hindsight now, they would not be allowed to buy the Waldorf Astoria like they did. Right? Has anyone ever been to the Waldorf Astoria? No? Yeah, you've been there? So you know that they've got the president normally would stay there. And there's a train that goes to Grand Central. And when they have the UN in session in September, the president would always stay at the Waldorf Astoria. Then the Chinese bought it, and the president stopped staying there. Did you know that? They stopped staying there. Yeah. So every president always stayed at the Waldorf until the Chinese bought it about 15 years ago. Yeah. And they go, oh, they might have bugged the rooms or something. But the trade deficit's a problem, because if you have, $100 billion a month or $1 trillion a year coming in, you can buy half an apple with that. So it's a lot of money that inflates US prices. So the more the US has a trade deficit, the more foreigners get US dollars, and more of those US dollars come back to buy US assets, whether they come through Australia or so, the OPEC plus countries might cycle the money through another country, but that money is going back into the US to inflate US prices. So it's a system of having the US as a reserve currency that allows for the inflation of US prices and inflation of US assets, which is inflationary, right? And that's been going on for, as long as I've been, right? Mortgage applications down 6%. So when we see the price of money going up, suddenly we've seen a drop off in mortgage applications, existing home sales down 5.4, and consumer confidence is dropping off. So even though unemployment didn't change from 3.6, we're seeing people less confident in being able to maintain those jobs, which is a reasonable thing. I mean, they're talking about job destruction. So we're seeing the consumer pulling back a little bit. But for this earnings season, Amazon and Kraft and some of those consumer products, well, we see bad news in Procter and Gamble and in Dwight and Church, which is the sort of little Procter and Gamble that's domestic focused, right? To make shampoo and soap and the government budget deficit, another, 88 billion. That's $1 trillion a year. That's a lot of money, right? So the borrowing, the cost to borrow from China and OPEC countries, they're going to, when OPEC and China get those US dollars, they're going to buy treasuries, but they're going to pay the US is going to pay a higher rate of interest to those countries. So it makes it more expensive for them, and it makes it tougher to maintain that budget. But I say inflation is transitory, and I'm feeling a little bit alone on this argument, but I say that the money that Biden spent on the stimulus package, the $2 trillion spent on the stimulus package, has been spent, and it caused inflation, and it's likely to fall off a cliff. So I think this raising of interest rates is just wrong. It should have raised interest rates when Biden decided to spend the $2 trillion, not now. And so there's also $4 trillion in quantitative easing, and both of those things are done. So that pig in the python, that big chunk of money that was distributed in a $25 trillion economy, you got $6 trillion in stimulus. That's a lot of money creating a lot of inflation. Mike, yeah.
Joe, is the war in Ukraine creating any impact or making an impact on manufacturing, for example, about demand for more armaments?
I think Lockheed Martin's making those missiles that they, those ground to ground missiles, but it's not moving the stock price. It's not moving the big needle on that. I think that, I hear a lot, haven't looked at the actual supply demand numbers for grain, but, the big moving piece now is the Russian gas. And the Russian gas, of course, what they're saying in Russia is we're going to supply less at a higher price. And so that's causing European countries, particularly because that gas comes through the North Line into Germany, and that's going to affect German manufacturing. So German manufacturing in particular is going to have to deal with much higher costs of energy, and they're going to have to find alternative sources, and that might be importing LPG from wherever they can get it, right? If it comes from the US is what I heard, but why wouldn't some of it come from Perth? Maybe that's already contracted out to the Chinese or something. I don't know. But they're going to be scrambling to restructure a lot of supply for energy, especially in Germany, who, and I think France less vulnerable because they've maintained their nuclear capacity. But, Germany in particular tried to go green about 10 years ago and eliminated a lot of their a lot of their capacity. They're very dependent on Russia. So I think Germany is the vulnerable. Does that answer the question generally? But I don't know about the supply and demand numbers exactly for grain. But I was joking around, instead of having bread, we'd have cornbread, right? So instead of wheat bread, we'd have cornbread or something. But that doesn't seem to be the case. I thought we'd have Julia Childs doing new recipes or something. But
When you wait for the wider world, not the US, right? The US is a huge producer.
yeah, so do we have a problem here? Are we informing we here? Sure.
I'm sorry. Australia produces food.
Australia does, yeah.
Yeah.
So
3% of the world.
So we have 3% here. So we're exporting.
3%. As well.
So who needs it? Europe, right?
I think most of the Ukrainian grain goes.
Well, Africans don't eat a lot anyway. That's a bad thing to say. They have their own food supply problems, right?
Yeah, no, it's quite serious. It's about.
Yeah, I suspect that would be a big problem.
But just to comment on those sort of supply chain challenges and our portfolio, the stocks that come to mind are Boeing, we've got myriad challenges in what is a turnaround investment thesis. They've got some assets in Russia, but they haven't really flagged any supply chain issues as such. It's more other challenges there. And the other one that comes to mind is Bayer, who reports earnings tomorrow night, I believe. And they should be a beneficiary in their crop science division.
Real GDP fell 0.9%, but if you consider so that's not including inflation. With inflation, the GDP up is 7.8%. So, but what they like to look at is the real GDP, the real production, taking inflation out. And so we're at 25 trillion of GDP, and we're at about 30 trillion in debt. So the amount of debt in Japan is like a 200% of the GDP, and that came about after the miracle of the 80s. And then when they bought the golf course in California, Pebble Beach, and their currency was very valuable, and they had, the Japanese economic miracle. But since then, they've gone completely sideways, and they don't have children in an aging population, and it just goes to the right. Nothing ever seems to be happening there. And I wonder whether they're stuck in this long-term low interest rate, no growth scenario. And is the US similar? Now, the big difference, of course, between Japan and where's Matt? Is Matt there? Matt was raised in Japan. Matt's, if you guys haven't met Matt, he, every year we have some lacrosse guys come down here and play for the club, and they help out here. Went to Loyola, but his father was an investment banker in Japan. He grew up in Japan. So he would tell you that it's Japan is, a lot of people with the same nationality, a lot of very, what's the word he used for it? What? Homogeneous population. Whereas the US, they'll import people from all over the world, right? Very big mixing pot. And Australia, I think, is the best in the world at mixing races. I mean, just they've done so well. And America's got all kinds of racial problems, but Australia's really done very, very well with racial integration. But Japan doesn't have that source of young labor, whereas we do here in Australia. So as a result of this, though, what we're going to see is a Republican landslide. Steve's on holiday at the moment. We would turn to him about the election. But Chris, you want to comment on how many seats are up on the election?
It's about a third in the Senate and all in the House. So yeah, it's expect a Republican landslide and the balance of power to shift.
Senators get a 6-year term.
Totally stagnant. I think we'll stagnate.
Well, the Republicans will get control. So the Democrats will retain the executive office, but in the legislative branches, the Republicans will get control, and then there are a number of governorships up as well. So the question becomes, will the Democrats lose control of the Senate and the House, and will they not be able to pass anything? Will be stuck for 2 years, right? So we need bipartisan, but Biden doesn't really seem to be too with it, and driving much change. So I think it's going to be a fairly dry 2 years, right? Bottom up, sell the rumor, buy the fact. 74% miss, 75% beat, 21 miss, 4% matched. Markets up on bad earnings, on good earnings, better than horrible earnings, right? But the economy is bad, so the forward-looking statements are conservative, but that was all more than baked in before we got to the results. Earnings per share are surging for oil, transportation, and for consumer services, particularly hotels and restaurants had a good quarter. So Brinker, McDonald's, Starbucks having good results, and Marriott, where we're down for financial. So a higher interest rate has squeezed some of the profit margins for the banks, but they'll be able to push through some of those increases and recover that next quarter.
That's pretty similar normal ratio of the 75-21.
It's pretty normal, yeah.
Yeah.
But the quantum of the overall beats is smaller.
Okay.
Yeah.
It's tiny.
Yeah, it's not
Right.
beating by 20%. It's
Yeah.
beating by 5%.
So we had since the last quarter of 2021, we had composite earnings growth more than 10% per quarter, so year on year. And it looks like we're not going to quite reach that 10% growth this quarter. It's beats up smaller.
Amazon is a good example of, they lost money and we're not necessarily looking at their profit as much as their cash flow. But they're a good example of a company that, and part of the reason that they disappointed was a write down in their electronic vehicles company that they invested in, Rivian. So part of that was a write down, but they did disappoint even with that write down, and the stock rose significantly. Okay, on financials, higher interest rates, sorry. Higher interest rates spells the end of the virtuous cycle. So Chris, would you like to talk about what the virtuous cycle means and why we're calling for an end to that?
Yeah, I mean, sort of touch on it with the Goldman
Yeah.
slide, but the virtuous cycle.
Introduce it.
The virtuous cycle is one of our macro themes, has been for 5+ years, and it describes a situation where cheap and cheaper credit and rising equity valuations will beget a virtuous cycle of merger and acquisition and investment banking activity. And one way to try and invest in that team is to pick a stock that might be an acquisition candidate, but a more conservative approach is to find an investment bank whose our investment bank was Goldman Sachs, and the leadership and market share in that industry tend to be pretty consistent. So we've been a beneficiary of this virtuous cycle through our investment in Goldman Sachs. However, with the rising rates and less high equity valuations, that virtuous cycle tailwind is starting to unwind.
So the virtuous cycle is a key reason for owning Goldman Sachs, and they were making $15 a share. The investment banking business just drops because the cheap money, the borrowing for M&A and the IPO market dried up, and so their earnings have. Investment banking crashed, but the fixed income, currency, commodities trade business continues to surge. So everyone else that are more on the traditional side of banking, not the Goldman Sachs or Morgan Stanley's, but the Bank of America, Citi, JP Morgan, Wells Fargo. Well, Wells Fargo has more exposure to mortgages, but the other ones with trading businesses continues to do well, particularly Citigroup. And so we'll be looking more for, we've had a big issue in the last several years with write-offs as we go into the pandemic and write-backs. And so these write-offs and write-backs are going to be less important as we move forward. And we'll be looking for new loans, and are they making good new loans? So it's how quickly are banks building their loan book will be an important part of the look forward. And that's why we're shifting into Citigroup. So we're looking for interest margins and the qualities of loans. Chris?
Yeah, so the three reasons we're selling Goldman Sachs. A virtuous cycle thematic is unwinding. The stock is now trading at a premium to the book value. That's another key component, and a common element in our investment thesis for a number of financials that we invested in really post the financial crisis. We have had a lot of success investing at a discount to book value and seeing it that discount close or even a premium achieved, and City's no different. I'll elaborate on that. Beyond the Wall Street style divisions, Goldman Sachs has been looking to diversify. I think really the aspirations have been to become more of a JP Morgan style bank with a greater wealth management and consumer banking. They have been very slow in those ambitions, and also they remain unprofitable for the foreseeable future. So those three reasons have prompted us to look at alternatives, and so that leads me on to Citi, who were really an anomaly this quarter with their results. They navigated a lot of the challenges that the Wall Street banks had, and Goldman exemplifies, but also what the Main Street banks experienced in that they've got relatively anemic loan growth in rising rate environment, and also they're experiencing rising provisions for debts, but really normalizing after last year. Really, they're pretty well back to pre-COVID levels. But Citigroup had well, there's three sort of developments this calendar year, which I think are positive. The installation of a new CEO from within the bank, from the consumer bank in February, then an investor day in March where the bank outlined what we believe are pretty reasonable and reasonable strategies to improve operating performance that also importantly have pretty low execution risk, things like exiting a few foreign markets, carving off some more peripheral assets. And then the quarterly earnings, of course, was sort of the third positive event. So looking into the quarterly results, revenue growth of 11%. It was really driven by the institutional client group where Treasury and Trade services to corporate customers was in high demand, and also their equities trading division was a bright spot. The trading overall is about a quarter of their revenue, and the private banking and wealth management division benefited from US credit cards. So it's an interesting climate where consumer credit is demand remains robust, balances are climbing, spending, transactional volume is also climbing, especially travel and entertainment, as people can now travel again. And that oftentimes comes with higher margin. Also, it's something of an inflation hedge because as average ticket prices climb, so do their fees, and that credit card division is about 12% of revenue. Reasonable, below industry, but reasonable and growing return on equity, improving their capital in compliance with the ongoing ratcheting of capital requirements, and fairly controlled operation expense growth. So really quite a clean result, which navigated, as I said, the challenges that Wall Street and Main Street banks generally face. And it's one of the only major banks that, well, the only major bank that trades at a discount to book value. So our thesis is that discount will close as management executes on their operational improvement strategy.
Yeah, so just reviewing the numbers here for the quarter, about 20 billion in revenue, about 4.5 billion in profit, and they're returning 1.3 billion to shareholders in dividends and share buybacks. So the amount of money going back to shareholders is possible because of the very good capital ratio, and they've got a good debt to equity ratio. This is the tangible book value. So the tangible book value is about $85. The share price about 52. The tangible is about 85, but the book value is over 90. So it's just the tangible, immediately accessible book value that puts it at 65 times earnings, which, if they were to be liquidated today, you'd get $85. So the market's betting that Jane's going to lose a lot of money. So in other words, it's trading at a discount, and that should be, and it's trading at a discount because there's uncertainty about Jane. Jane Fraser, is she going to come in and do a good job, or is it going to be more of the same of what it was under the prior management? So it's a bet on new management and an uncertainty on that. So we'll see as she proves herself that discount to book value improves. So that's the risk profile of the stock. Any questions on Citi before we go into some other stuff? Procter & Gamble, we're seeing their earnings estimates coming down from 690 to 640 over the last 4 months. So we see those estimates coming down, and the management's talking about severe cost and operational headwinds. So this is a big company. It's $80 billion in sales. It's a global company, and you're using their stuff every day, right? So you're using their deodorants, their soaps, their shampoos, their dishwashing detergent. I'm, one of us here have young children, but their diapers and things. So they're a big company with a lot of product. Sales up 3%. That's below the inflation rate. They have lower foreign earnings as they have a headwind on a stronger US dollar and foreign earnings. Their prices are up, so their volumes are down, and they're blaming Russia. So they're saying, well, the Russian issue is part of the problem. The lockdowns in China are part of the problem. And similarly, Dwight & Church, which also sells soaps and detergents and shampoos, they've only got $5 billion in sales versus Procter & Gamble at 80. They're a little company compared to Procter with $5 billion in sales for the quarter, for the year. But they are more set, they're like 80% US focused, so they don't have that foreign head, but we're seeing other similar problems with raising prices, but not able to make that stick with the consumers who are buying less. So that's what's going on in food as well. And remember, Kraft merged with Heinz, and there was a buyout firm in Brazil, and they're highly leveraged and trying to work off that leverage and really extract some value from their core brands, which is cheese and beans. But the PE is down to 14 or 13 or something. So even though you've got debt going from 30 to $20 billion at Kraft, you have the PE as being pretty low. So I think Kraft is probably a very tempting company to buy. Sales are up 10%, price is up 12%, and that's offsetting an increase in raw materials and transportation costs. But I think Heinz is very interesting and very tempting to buy that stock at 13.5 or 14 times earnings. Chris, do you want to take over for media and entertainment for me? Is that all right?
Sure. Netflix result was characterized by less bad than the feared subscriber numbers, but it really exemplifies these relatively low profit, very high growth, technology oriented businesses in helping the brunt of this correction. Our investment is in Paramount, who report. So what have we got? I think Paramount a report tonight. Well, I'll touch on Active first. Yeah, and it was a flat performer for the month on no surprises. News, but no surprises. The UK regulator has joined the US regulator, the FTC, in scrutinising the Microsoft deal, expected, and Activision reported second quarter results, which were, I mean, pretty much in line. Nothing, no cause for concern there. Earnings estimates for next financial year down a smidge. And really, you know, what we're assessing here is what the downside risk is as a standalone if it's not acquired, and there's been no change to that. If this deal is scuppered, Activision as a standalone remains a solid business, performing well, and will receive a $2 billion break fee from Microsoft. But if the deal closes, as we expect it will, we'll receive $95 cash per share, and that represents an IRR of about 22% in the current price.
Yeah,
so this is not.
Could you go back a couple of slides,
Yes.
please, where you showed the streaming services?
Yes.
Yeah, next one. Wow, market cap dropped that much. Eh?
Yeah, the market cap in Netflix went from 250 to 100.
Good God.
Yeah, they
Plenty of companies that have lost 80% of their valuation. And this is after the bounce, 25% this month. So it's got a ways to go.
Microsoft buying Activision Blizzard is a giant deal at $66 billion. And the regulators are all looking at it, but it's going to pass because it's Microsoft throwing into the game, and it's not really direct competition. Now it'll go through the Microsoft platform, but it is going to pass. And all this noise about the UK or other regulators looking at this deal, it's just a matter of time to get this passed. You will, I'm sure, get your 22% on the takeover arbitrage or the workout.
Standard part of the process. Paramount reports on the 4th, and similar to the other subscriber sort of streaming businesses and subscription businesses more broadly, our focus will be on the subscriber edition. This Paramount Plus streaming is performing quite well, off pretty low base, but it's a strategy that we endorse as investors, and we've seen quite mixed metrics from other subscription platforms, including elevated churn rates. It's very costly to acquire new customers. So if you've got a sticky platform or you've got in-demand content, that can help. But beyond the streaming, they're also a film studio with the very successful latest Top Gun installation.
Pharmaceuticals are not interesting this month. Veritas reports tonight.
Okay. My actual
Well, on the eighth,
uh,
sorry.
Yeah, the forecast is
Moderna?
flat. Yes, and Moderna is tonight. 2023 earnings estimates up 2%. We expect a lot more robust Spikevax revenues than the
Is
consensus.
there tonight?
There seems to be this, yes, there seems to be this, most of the discourse among Wall Street analysts looking at Moderna is around COVID vaccine revenues, and we have from the outset viewed that as just a proof of the mRNA based platform, which can be applied to other vaccines. And so the very robust revenues and cash flow of Spikevax, we think, are greatly underestimated by the average analyst, as we continue to deal with new variants and get more and more boosters. Moderna's in phase 3 trials for an mRNA-based flu vaccine, but they have about, and we will call for updates on that, but they have about 23 candidates. So we're excited for the long-term prospects for the mRNA platform to develop other vaccines in a very nimble fashion.
Natalie and I both had our boosters on Wednesday, I think it was, and we had the Moderna one, and I had no side effects for my second booster, and I think Natalie was sore the next morning on the shoulder or something. But Walmart, again, stock up 8% on down earnings, so it's more of sell the rumor, buy the fact. The stock's down from 160 to 120 after gliding down, and they warned. Internet stocks, Amazon, another example of a stock going down and down and down and then up on the earnings announcement, even though they lost money. Their stock is down from 170 to 105. It probably, like Mike pointed out the market cap change in those, but they invested in Rivian, the startup EV company, and that investment they had to mark down. Alphabet. Chris.
Yeah, leading into the result, there was a lot of trepidation because some of their peers who rely on ad revenue had terrible result, frankly. But the highlights in Alphabet's result were the advertising and cloud. Meanwhile, foreign exchange was a little bit of a headwind, as was headcount increases. These Alphabet and other large technology businesses are always trying to balance investing for growth with profitability. Revenue was up 13%, $70 billion a quarter. It was 16% growth ex foreign exchange. So 3% foreign exchange headwind to revenue. Ad revenue up 12%. That's really the cash cow, the key profit driver of the business. And that was driven by search, people searching for travel. Meanwhile, YouTube's slightly disappointed, also part of that division. Cloud revenue grew 36%. Very pleased to see Alphabet quickly getting scale in that division. It is still loss-making, which I think demonstrates the scale and investment required to be a player, a competitor. That growth outpaced Amazon, the market leader. Microsoft, the market leader, and Amazon. See their growth rates for the quarter and their quarterly revenue for their cloud businesses. So Alphabet's on the right path there. Path to profitability is clear. Operating income just under 20 billion. It was flat year on year. The margin was down from 31% to 28%, and that's been attributed to headcount growth. So pretty significant increase in headcount, but plans to slow hiring in the second half. They also bought back about 15 billion worth of stock in the quarter. It's about 1% of the market cap.
Yeah, so this stock's been doing very well for us. I mean, a lot of stocks in the high growth end of the market have been falling a lot, and they fell less than others, but they've lost some value, but they're still doing much better than others. So, you look at the FANGs, look at Netflix and Amazon have been hit much harder than Google was ever hit. and or Alphabet was ever hit. So they're doing fine. Semiconductors, Micron put off the alarm bells last month, and the average stock was down 22%. This month they're up 22%, excluding Intel. Intel was the one exception. They were earnings estimates are down, and the stock was down 10% more on top of a 30% fall in the prior month. So Intel is really struggling there. Qualcomm, Chris, about 5G is still ramping up.
5G ramp, and notably in absence of supply chain issues, they have pivoted towards the higher margin product to address any limited challenges they've had with supply chains, but also they're pursuing beyond the very compelling tailwind in the 5G smartphone ramp, which is multi-year handset upgrade with higher value and higher total content in the devices. They're also growing in hands there. They're also growing Internet of Things, and automotive businesses are even further accretive to their margin. And
It's a pretty small part of the business right now, but it will be there.
It's relatively small now, but very impressively, it's contributing to margin improvement on what is already a high margin business. Revenue is up 37%, almost 11 billion. Handset revenue, which is the majority, up 59%, and Internet of Things and auto up impressive numbers. It's particularly auto, relatively small in the overall business. But if you look at the profit growth compared to the revenue growth, that's really illustrating this margin expansion. There was a little bit of give and take in the result and the guidance. This was their fiscal third quarter, so only one quarter remains this year. They lowered their global smartphone unit sales forecasts, and they've attributed that to China lockdowns. But they expect that to be offset by share gains in higher value Android devices. And they also announced a long-term licensing contract with Samsung to 2030. So they're really firing on all cylinders.
So, Chris, how did they achieve such a huge increase? One quarter.
Well, a lot of that was because they had the inability to produce enough at Taiwan Semiconductor. So they'll design it, they'll get Taiwan to make it, and there's not enough capacity. So if they're not getting enough capacity in Taiwan, they're unable to supply the car chips. They're unable to supply the internet. So somehow they've got access to more chips, or raised their prices, or got through some of those bottlenecks with not being able to get enough product through. And then once some of their contracted prices are done, then they can move on to higher prices. So it has to do with shortages on manufacturing capacity.
Yeah.
The Apple deals held together as well, isn't it?
Yes.
Deals held back.
And
A lot of metrics in the last 2 years, whether it be economic or broad economic metrics or company specific, the year-on-year figures are experiencing what's broadly called the base effect, where the year ago figure might have been a significant decline. So it sort of skews this figure, and a lot of companies are focusing instead on, say, a 2-year compound annual growth rate to try and get something a little bit more comparable to pre-COVID, which, I mean, even that now is sort of starting to experience a base effect. So yeah, it's important to be cognizant of what the year ago comparable is. But for the year, Qualcomm's guiding for almost 50% revenue growth per handset.
we got
So it was slightly above this quarter.
five to go. So
That's about it, I think. Oh, that's okay. Because that's really we don't need to laugh. Western Digital reports results on the 8th of August with unchanged earnings estimates of their fiscal fourth quarter. The relatively new CEO is driving revenue and margin gains, focusing on cloud customers, but the stock has just continued to languish. I think it's 6 times earnings, despite those improvements in the fundamentals, and that's attracted a very well-known activist who's established a 6% stake in the business, but has also flagged a commitment for at least another $1 billion in support of what they're proposing to split up the two divisions. The belief is that that might unlock shareholder value rather than being part of a conglomerate with two different businesses. So it's nice to have a catalyst, is why that's notable. And at Boeing, the turnaround is supported by a lot of indicators, leading indicators. And as we say, cash is king. They're not trading on a multiple of depressed earnings or revenues. It's very important that we don't get diluted as investors. And so the liquidity position and the quarterly cash flow figures are of utmost importance. And Boeing had a big beat on that metric. Also, second very positive news item this month was the FAA, the US regulator, has approved a plan to fix a fault, to inspect and fix a fault with 787 and then resume deliveries. So two positive developments. And meanwhile, the commercial orders and the backlog and the TSA travel numbers continue to improve, approaching, well, still a ways to go, but about 75 or 80% of pre-COVID levels. The TSA travel numbers.
6% yesterday and 3% last night.
Yes, so even after
Down 3% last.
after
Well,
this
since
is
it's down. Since
about up 20 or 18% on a month and a day.
Yeah.
Fair that way. Yes, and Bayer reports earnings tomorrow night. Earnings estimates have increased in the month by 5%, and as we discussed earlier, with crop science will be a beneficiary of supply chain sales and weather.
oil and gas is really very, very profitable, huge margins at the moment. It's at its peak cycle. So some of the P's are very low. Apache at 3.2. Earnings estimates are up tenfold in the last 18 months, and that's not sustainable. Exxon with record profits. Chevron announcing a 50% increase in their buybacks. So a big increase in buybacks there, which is a big vote of confidence by management in the long-term sustainability of those earnings. BP earnings estimates up 27%. And the concern is that refining margins may not be sustainable at 40%. And refining, well, it's a big talk about refining. But oil and gas, Europe is still struggling with the cost of gas coming from Russia and having to shift around and find substitutes on that. So the scramble is on to find substitutes for especially the German manufacturing sector and for India and China, by the way, and Saudi Arabia buys Russian oil. Does that surprise you? It surprised me, right? So what they do is they buy the Russian oil and they consume it domestically and they export their better quality stuff. So that's just one way that Russia and Iran are able to export their oil to India and to kind of India says, well, Ukraine's a European problem. We're still willing to buy Russian oil, right? So they don't mind. So that oil goes out into a ship, get mixed up, and you know these smugglers are moving that around despite the U.S. saying we don't want you doing that. But we're not buying oil stocks. Here we can see the price of gold. Is that gold? No, that's Bitcoin. Wait, is that gold or Bitcoin?
Gold and Bitcoin is not inflation.
No, this is Bitcoin going from 60,000 to 20,000, and this is gold going from 1,700. Am I mixing this? To 1,700, from 3,000 to 1,700. Is that right?
3,000.
2,000. From 2,000, that makes more sense, to 1,750. So, and Barrick and Newmont are down, which is against what you'd expect from an inflation hedge, okay? So that, and Rio and BHP earnings estimates are getting slashed, right? Which is the opposite of oil. So we're seeing earnings estimates getting slashed for those stocks. So our recommendations are changed in that we are selling Goldman Sachs and buying Citigroup. And otherwise, there's no other changes to the portfolio. So I think we're right on time, and we're happy to stick around and have mineral water. So thank you. Any questions? Thank you very much.
Can we get a copy of that?
Yeah, in fact, the whole thing will be brought. So yes, we can send you the report. Normally we print it with you now. I think the Richard didn't get around to printing today, but yeah, we'll email it to you, we'll email you the PowerPoint and the actual report itself, yeah.
Appreciate
And then this will be posted on YouTube as well. If you just feel like, going back over some sections of it.
Right.
It's a whole hour on YouTube, it's a long.
Cool.
Okay, thank you very much.
Thank you, everyone.
Thanks very much.